Okay, dear students, first of all, welcome to everyone in our ACCA pre-scene FM mock. Your attempt is March 2026, and I am Abil Ahmed, CEO and Principal of Abil School of Accountancy. So let's start. A very first question of the ACCA pre-scene mock FM March 2026. But let me tell you one thing. In order to get the maximum benefit from this pre-scene mock, the good approach is first student they should attempt, and then obviously you can first attempt and then attend this class. Okay, and towards the end of the class there will be a little bit announcement. Obviously that announcement is going to be more inclined and more, I would say, towards enrolled students, what sort of benefit they can get. Let us start from the first question. Which of the following statements correctly compares the traditional view of capital structure with the Modigliani-Miller theory without taxes? If you just recall traditional view of capital structure, actually in traditional view of number one main concept is, according to the traditional view of capital structure, companies should try to maintain a balance between debt and equity. You should be maintaining a balance between debt and equity. Plus, according to the traditional view of capital structure, when you start introducing debt in your capital structure, then what happens? Your WACC will start reducing it because debt is a cheaper source of finance. But it does not mean that you keep just introducing debt in your organization and you keep increasing debt in your organization, because when you will be increasing debt in your organization, then obviously financial risk will also increase. So the main, I would say, theme of traditional view is organizations should be maintaining a balance between debt and equity. And according to the traditional view, optimal capital structure is the capital structure where your WACC will be minimum. But when it comes to without taxes, then according to without taxes, gearing has no impact. According to no tax, no matter in your company you are raising the finance, it will have no impact on your cost of capital. Now let's see what they have given us. The traditional view states that an optimal capital structure exists, yes, that minimizes the WACC. Till here it is very true. According to the traditional view, optimal capital structure is the structure and which exists also where your WACC is minimum. Whereas theory argues that WACC remains constant regardless of the level of gearing. That is 100% true. Because according to no tax world, actually gearing will have no impact. Either there's a gearing in your business or not. According to tax world, your WACC will remain same. Either you are increasing the gearing, you're not increasing the gearing. That is no tax says. So statement number one is very much true. The traditional view claims that firm value is independent of gearing. Actually, this is not traditional view. It is no tax world. Actually, no tax world says that the business value is independent of gearing. While theory suggests that firm value increases as more equity is used. The second statement is actually false. When we say without tax, so without tax says value of the geared business will be equal to value of ungeared business. The traditional view considers all increases in debt to be risk-free. All increase in debt to be risk-free. Stop. Actually, according to the traditional view, what happens? Let's say this is my financial gearing on x-axis, on y-axis I've got WACC percentage. Traditional theory says when you will start bringing debt in your capital structure and slowly and gradually you start increasing the debt, then what happens? Initially your WACC will keep reducing it. But after a certain financial gearing, if you introduce more debt, then your financial gearing will increase. Assuming somewhere here your WACC is minimum. So basically, according to the traditional theory, you need to maintain a balance between debt and equity, because every time when debt is coming to the business, your financial risk will increase. So they are saying the traditional view consider all increase in the debt to be risk free. This is not the case, because we are saying after certain gearing, if you introduce more debt, then your WACC will increase, and every time when the debt is coming, financial risk will increase. While theory assumes that debt always increases the firm's risk of, so this is not. So according to without tax, as we have already discussed, according to without tax, you just keep increasing the debt as much as you can. So this statement is also false. The traditional view assumes perfect capital markets, while theory assumes market imperfections such as taxes and transaction cost. Actually, theory without taxes, they are the one they actually assume, not the traditional view. They actually assume that stock exchange is a perfect capital market, not traditional view. So logically, the answer is alpha, the first one. Let's go ahead. Okay. Using capital asset pricing model CAPM, and they are saying what is written. This is important, students. Ignoring what? Ignoring taxation. What is the risk adjusted cost of equity for the new project? Students, I have a question. What is the risk adjusted cost of equity? If you recall, risk adjusted cost of equity we need in the context of, in the scenario of diversification. When my company is diversifying means I'm going to make investment in a known core activity. Diversifying means I'm going to do something different. I'm not making investment in the same industry where already I'm operating. So whenever there's a diversification, then actually we need a risk adjusted cost of equity. How do we calculate risk adjusted cost of equity? Very simple. Step one, you need to find out the beta asset of the new industry. The question is, how will we find out the beta asset of the new industry? Is very simple. Where you want to invest, where you want to diversify, in that industry, examiner will give you the proxy company. Simply, examiner will give you your competitor, which is already operating in that new industry. All you need is take financial gearing of your competitor in the new industry. Take equity beta of your competitor, proxy company in the new industry, and de-gear that equity beta. So step one is, what is the approach of calculating risk adjusted cost of equity? Simply, to find beta asset of new industry, examiner will give you the proxy company in the new industry. Take equity beta of proxy company. You need to de-gear this equity beta. De-gear means ungear to get beta asset. Once you have found beta asset, take that beta asset, then gear up with your own financial gearing. That will give you beta equity. Then use this beta equity into CAPM. By following this process, whatever the KE comes, that will be risk adjusted KE. Okay, one more thing. Don't forget one concept. Beta equity is always greater than beta asset. Question is, why beta equity is always greater than beta asset? Actually, equity beta is a two risk beta. It has business, it's a measure of business plus financial risk. Beta asset is a one risk beta which only measures the business risk. So it makes sense 2 risk beta must be higher than 1 risk beta. So beta equity is always higher than beta, is always higher. How much higher is not the concept. The concept is higher. It could be beta equity is 1.1, let's say beta asset is 1. That is not a problem. The main concept is equity beta must be higher than beta asset. That is a concept. How much higher is not a concept. Why it has to be higher? I've written the reason. Beta equity is a measure of business as well as financial risk, and beta asset only measures the business risk. Okay. So first, we need to find out the beta asset of the new industry. Examiner will give you the proxy company in the new industry. Take the equity beta of proxy company, D-gear, you will get beta asset. Which means that beta asset is equal to beta equity into market value equity divided by market value equity plus market value debt 1 minus tax rate. This is the normal formula which we use. But look at the question. It is categorically written ignoring taxation. If I ignore tax without tax, it is written in the question. That's why we are doing it. Otherwise, normally we use the normal formula which is VD 1 minus T. Without tax, it's going to be beta asset is equal to beta equity, market value equity upon market value equity plus VD. There will be no tax if I ignore the taxation. By using this formula, we can calculate beta asset. Beta equity of proxy company, market value equity of proxy company, market value debt of proxy company, I'll be using it to find beta asset. Okay. Now let's read the question. And when do we need to calculate risk adjusted KE? Whenever there is a diversification. Diversification means we are going to do something different. Like some of the students, they are doing something different today. They are studying today, mashallah. It does not mean diversification. You should have been doing every day rather than doing just today something different. Now let's read the question. Aurelia, if I'm not wrong, Aurelia company and all equity finance business. Stop. Students, some of the students, they make such silly mistakes, They just, I believe when we saw their, when we see the copy of those students, they are just, I would say shouting or maybe crying that marker, please fail us. We don't want to pass. Why? Look at this, what it says. Aurelia company and all equity finance company. When your company is all equity finance company, in that case, in capital asset pricing model formula, while calculating KE, students, you will be using beta asset. You will not be using equity beta. When your company is 100% equity finance, it means you are not facing any financial risk. There is no debt in your business. When we say equity beta is a measure of two risks, one is business, another is financial risk. Businesses, they only face financial risk when there is debt, loan in their business. And look at the first line, the question says Aurelia company is an all equity company. It means in case of diversification, whatever beta asset you have calculated, same beta asset will be used in CAPM. Some of the students, they just read the question again and then they do something, I don't know whatever they do. Unnecessarily, they convert that beta asset of the new industry by using XYZ information to equity beta. Obviously, you are making a mistake. Then it means you are unable to understand the question. Aurelia company and all equity finance company is evaluating a potential project in a completely new line of activity. The company's current equity beta is 1.3, which is irrelevant for me. Why irrelevant? Because we are diversifying. And some of the students, I would say, being too much critical. Then they say, sir, if it is an all equity finance company, why the examiner has written that company's current equity beta is 1.3, just to make you confused. Logically, when business is an all equity finance company, then your equity beta is also beta asset. Just by writing equity beta 1.3 does not make it equity beta itself. For example, there is a student Y. Mr. Y does not study at all. If someone says he studies a lot, it does not make Mr. Y a intelligent student. He is not studying at all. Your company is an all equity finance company. Examiner has deliberately written equity beta so that you just keep thinking. Number one, it is irrelevant, not relevant for you. Number two, some of the students, they say, then why is written equity beta if company is an all equity finance company? Always remember one point, one concept. When your company is all equity finance company, then logically your equity beta, beta asset both are equal. In the proposed business area, a Harrow company operates in the new business where we are diversifying with an equity beta. Now that proxy company is having an equity beta of 1.5 and a debt upon debt plus equity ratio is 35%. Students, to be very honest, I would say 70% of the student, they make even mistake here also, which they should not be doing at all. How to even convert the equity beta of Harrow company to beta assets? Some of the student, I'm saying even more than 50% student, they will be making mistake here as well. Why would they be making mistake here as well? Because they do not properly utilize the financial gearing formula. I'll explain right now. Look at the formula which examiner has written. Debt upon debt plus equity is 35%. When your examiner has given you debt upon debt plus equity 35%, the logical meaning is debt in this business is 35% and equity is 65%. Because look at the denominator, debt plus equity combined will be 100%. Look at the formula, debt, then there's a bracket, debt plus equity is 35%. It means Harrow company is having a debt 35%, equity 65%. Now first we need to convert this equity beta of 1.5 into beta asset. And before I calculate the answer, whatever the answer comes, logically the answer must be lower than 1.5. Why it would be less than 1.5? Because we are converting two risk beta into one risk. And we'll be ignoring the debt tax as well because it is written in the question. Equity beta is 1.5. Market value equity 65%. Just write 65, 65, 35. That will give us beta asset and logically less than 1.5. So 1.5, students, I'm getting the answer 0.975. Now listen, everyone knows that in CAPM, K is equal to RF, risk-free rate, plus RM minus RF, and then we have got a beta equity. But here in this question, instead of equity beta, we'll be using beta asset. Why will we be using beta asset? Because in a very first line, it is written, Aurelia company for which we are solving this question, they are 100% equity finance company. So when company is 100% equity finance, then your CAPM formula will be K is equal to RF plus RM minus RF. Then instead of equity beta, you'll be using beta asset. Plus one more thing, RM minus RF, the difference of RM minus RF is equity risk premium. This is equity risk premium. Another name for equity risk premium is market risk premium. So why we will be using beta asset in this question? Because Aurelia company is a 100% equity finance company. Beta asset we have calculated 0.975. So K is equal to, student, risk free rate is 4% and market risk premium. Market risk premium is the difference of Market risk premium is the difference of RF minus RF. RF is 4%. RM minus RF is 5%. Multiplied by beta acid, which we have calculated 0.975. Whatever comes, that will be a percentage. 5 into 0.975 plus 4. Students, I'm getting 8.875. If you do not get the exact answer, then obviously go to the closest one. 8.875. Can I say 8.9? The nearest to one decimal. I hope it is 100% clear to everyone. Okay, now what it says. Calculate simply companies. Okay, so name of a simply, it's a name of a company. Simply companies. Inventory holding period 1, receivable collection period 2, payables payment period 3. And students, let me tell you one thing. Surprisingly, examiners report, they mention that student, they make too much mistakes in two areas, which I don't know why. One, they are making too much mistakes in working capital management. Another area is risk management. Too many mistakes students are making in these two areas, which logically student, they should not be making it, because both the areas are straightforward. They're not very difficult. Okay, what question is asking us to do? Calculate simply company's inventory holding period, receivable collection period, and payable payment period. So let's see. Inventory holding period. I need to have the value of inventory divided by cost of sale. Calculators. Inventory is 345 million. Cost of sale. Student, cost of sale is 2150. Let me check. Yes, 2150. And students, before you just multiply with 365, always read the question. I would say most of the time examiner mentions that how many days do we need to use. So let's see. It says, assuming how many days? 360 days a year, and calculation should be to the nearest day. Okay, 360 will be using it. So 345 divided by 2150, inventory divided by cost of sale, multiplied by 360. Students, I'm getting 57.76. Of course, the nearest will be, can I say, 58 days. So logically, your inventory holding period, is, can I say, 58 days? Okay, now let's go for receivable collection period. Trade receivable collection period, which they need in days. Again, first we need receivables divided by credit sales into 365. Receivables divided by credit sales multiplied by 360, the which is mentioned in the question. Excuse me. Student, receivables are 455. I'm just writing receivables. Then I need to write, we need credit sales. Look at this. Very smartly, what examiner says, 85% of the sales are on credit. Normally, nothing is mentioned, and whatever the revenue amount examiner gives us, we assume the entire amount is on credit. But here, examiner has categorically, clearly, they have mentioned not the entire sale is on credit, only 85% of the sale is on credit, which is 3560. I'll take 85% of that. So let's come here. 3560. Let's take 85% of that. 3650. If I take 85% of that, I'm getting 3102.5. Okay. 360. Students, excuse me, I'm getting 52.79. So make it 53 days. Nearest, I've got 53 days, means make it, if we don't have 53, then I'll go for 54. Let's see. 3560, the revenue amount. If I take 85% of that, here was a little error. It is 3026. 3560, 85% of that is 3026. Okay. Into 360. 455 divided by 3026 into 360. Exactly, I'm getting here. There was a calculation error. 54.13. So obviously 54. So receivable collection period is 54. Now payable payment period. Payable payment period. First, we need the amount of trade payable divided by credit purchases. Nothing is mentioned, just purchases are given, always assume they are on credit. If purchases are not available, you are unable to calculate, then use cost of sale in the denominator. But logically, for payable payment period, cost of sale is not the first choice. First, I'll go for purchases. Not given, then I'll go for cost of sale. Trade payable is 220. They have given us the purchases 1251. 220, 1251 into 360. Nothing is mentioned, then entire purchases are on credit. 220 divided by 1251 into 360. Students, I'm getting 63.3. Obviously, 63.3 is the nearest is 63. So I just want to say one thing. Just whoever simply is able to recall the formula, if you remember all these formulae, then obviously this question will not disturb you. But if you don't remember the formula, then there is no choice. Then it becomes extremely difficult to answer. Unless you ask invigilator if they are ready to help you. Otherwise, there's no way. Okay, students, let's read this question. Water. Which of the following statement is are true? The sensitivity of NPV to a change in sales volume can be calculated as NPV divided by the present value of the sale contribution after tax. True, 100%. This is how we calculate sensitivity analysis of sales volume. NPV divided by present value of contribution after tax. True. The problem with the risk and uncertainty in investment appraisal is that neither can be quantified or measured. Absolutely wrong. If you recall a very basic concept, very basic, I would say, difference between risk and uncertainty. We say risk is quantifiable. Uncertainty we cannot measure. We cannot quantify, but risk is quantifiable. The lower the sensitivity margin, the less critical the variable is to NPV. Absolutely false. Why? Actually, what information do we get after applying sensitivity analysis? Let us recall. Actually, sensitivity analysis gives you the information that how much change, how much actually adverse change in your variables will make NPV 0. Repeat, how much adverse change in your variables will make NPV 0. For example, if variable cost assuming increases by 20% and NPV becomes 0. Of course, increase in variable cost is an adverse event. Assuming if fixed cost increases by 12%, NPV becomes zero. Assuming selling price reduces by 2%, NPV becomes zero. Now, if someone is asking us, there are three variables on which, let's say, we have performed sensitivity analysis, on which variable project is more riskier, I would say selling price. Look at this, just a small decline of 2%, just a small decline of 2%, just a small decline of 2% can make NPV zero. So it means your project is more riskier when it comes to selling price as compared to variable cost and fixed cost. Now, some of the students, they are obviously deep thinker, I would say. They say, sir, how it is possible that fixed cost will increase? Yes, it can increase. If you recall, there is a concept, the name of the concept is step fixed cost. So the point is, if you are applying sensitivity analysis on different variables, so the smaller adverse impact, if brings your NPV to zero, it means on that variable, your project is more riskier. It means that variable is critical. So they have written something opposite. The lower the sensitivity margin, actually the higher critical variable, they are saying less critical, this is more critical. So logically, only one is true. Student, you can see one thing in this pre-screen mock. All the questions, I would say, they are very interesting and very, I would say, almost every MCQs is depending on the concepts. Let's see the next one. Which of the following is an illustration of principal agent problem? Student, first of all, when it comes to a company, we say shareholders, they are the principal, they are the actual owner of the company. Agents, they are the management, they're the directors. Obviously, both are, especially shareholders, they are never happy with the agent. They always think that agents, they are doing something which is beneficial for them, but not for us. But still, you have to have this principal agent relationship has to be there. But what examiner is asking, which of the following is an illustration of principal agent problem? Let's see. Out of these four, which is creating a problem for the principal agent relationship? Let's say supplier cutting their cost by using cheaper materials to keep their prices. Student, just think, number obvious. So if supplier is cutting their cost by using cheaper material to keep their prices low, if they're keeping their prices low, I'm a shareholder of a company, I'll be getting at a lower price. Actually, here I cannot see any problem between principal and agent. I said principal is the shareholder, agent is the company's management, directors. Suppliers are not my agents. Excuse me. Managers avoiding debt finance because lower interest payments avoids the need for the careful cash management. Now, this, look at this one is going to create the problem. Let's read other also. Why this one will create the problem? I'm the shareholder of this company and my manager is saying, sir, we are not taking the debt. I'm asking why you are not taking the debt. Now, manager is justifying his decision. Manager is saying, sir, we are not taking the debt because just the lower payment, will be paying a very small amount as interest. So careful cash management is not required. That's why we are avoiding. They're lying with you. Why? When managers they are avoiding debt financing, it means they don't want to reduce WACC. We know that when there is a loan in the organization, if you recall the traditional view, when the debt comes in the business, which is a cheaper source of finance, It actually reduces WACC. The question is, if WACC reduces, what happens? Students, if the WACC reduces, then NPV will increase. So avoiding a cheaper source of finance and running the business is not logical. So basically, point number 2 is creating the principal agent problem. Now let's read more. Shareholder groups disagreeing over dividend policy is just a one issue. They're saying shareholder groups. It means not all the shareholder groups. So basically, they are saying shareholder groups disagreeing over dividend policy. It means some of the groups they agree, some of the groups they don't agree. Again, this is not creating a principal agent problem. The stock market exerting pressure on companies to achieve what? Short term. If they are exerting pressure on the companies to create short term profits, is if better if they are creating the short term profits. The main issue where the problem comes between principal and agent, if you look at the point number 2, I am the owner of that company, my managers are avoiding the debt and they're saying, so we are just avoiding it due to XYZ reason, then I'll step into that and I'll say, why you are avoiding a cheaper source of finance? That cheaper source of finance will bring the WACC, will make the WACC lower, and obviously ultimately NPV will increase, the business value will increase. So beta is the answer. Let's see. What is the equivalent annual cost using the machine if it were bought and replaced every 4 years in perpetuity to the nearest dollar? Every 4 years. Okay. All you need is just find out present value of one replacement over 4 years and divide by annuity factor. You will get annual equivalent cost. A machine costing 2,25,000 times 0. Useful life is 4 years, at the end of which it's estimated. Wow. Students, present value of resale. Examiner has given you the present value of residual value. Already, resale value is given to you in present value terms. So no more discounting to the residual value. Excuse me, because it is already in present value terms. Wow. The present value of total running cost over next 4 years. Examiner has already given you the present value of running cost over 4 years as well. Cost of capital is 10%. First of all, times 0, 2,25,000. Examiner has given us the present value of the residual value. Just I'm calculating the NPV of 4 years and present value of running cost. So let me use the calculator. 2,25,000. This is 555. Students, I am getting 2,65,267 negative. But please, while solving the question, whatever the answer comes, you have to just write here to the nearest dollars. Cost of capital is 10%. At 10%, 4-year annuity is 3.17. So annual equivalent cost is equal to 265,267 divided by 3.17. Annuity table that will also be given to you in exam. Students, I'm getting 83,680. Otherwise, how do we calculate annuity factor? Simply annuity factor is equal to 1 minus 1 plus I minus 1 divided by I. I is a cost of capital. So students, I'm getting 83,680. So annual equivalent cost of this question is 83,680. Let's see. If the share issue is completed, means company has issued the shares, and bank loan is redeemed. Student, company has issued the shares. Obviously, when company issues the share, the number of shares will increase. Company has redeemed the loan, then obviously, logically, my financial gearing will reduce. My interest payment will be safe because I have redeemed the loan. What will be the company's new EPS? First of all, how do we calculate EPS? Simply profit after tax divided by total ordinary shares. Obviously, we will not be using the exact formula of IS 33 which we use in FR. Here, just take profit after tax divided by total ordinary shares. Now, student, you need to know one thing. When company issues shares, number of shares will increase. When you are going to redeem the bank loan, you will be saving the interest. Let's see. मान लो company has 75 million ordinary shares outstanding. As reported, a profit after tax 35 million. The company proposes to issue 25 million ordinary shares at 1.2 each. They want to issue 25 million shares into 1.2 at 1.2. So how much cash they will be raising? 25 into 1.2. Students, I'm getting 30 million. And to use all proceeds to repay an existing bank loan that carries interest rate of 5% per annum. Now listen to me carefully. To use all proceed means to use all 30 million to repay existing bank loan which carries interest rate of 5%. It means entire 30 million will be used to redeem the bank loan, which means that 30 million into 5%, whatever the interest comes, that will be my interest saving. Why there will be my saving? If I repay the bank loan, then I'm not going to pay, of course, interest on that. Assuming operating profit before interest and remains unchanged, which is remains unchanged, and tax rate is, so it's a very common question. I think many times the similar question has appeared in exams, multiple times I would say. So it is not the first time that we are having such a question. Existing profit after tax, 35 million. Add interest saving after tax. Interest saving after tax. Company will be raising 30 million. Entire 30 million will be utilized to pay the bank loan. So we paid the bank loan of 30 million. On this 30 million, now 5% interest, no need to pay. But this is interest saving after tax. Tax rate is 25%. So 1 minus tax rate. Let's see. I'm getting, students, 1.125. Simply add both of them. Revised earnings are 36 point. Here comes your new EPS. 36.125. Already initially company had 75 million ordinary shares. Now they are issuing 25. Altogether they will become 100 million. So dollar 0.36125. Let's go to the nearest one. So students, the nearest option is Charlie. Okay. Which three of the following are the main macroeconomic policy of? When we say macroeconomic, you have to think in a bigger context. It's not micro, it's macro. Which three of the following are the main macroeconomic policies? It means whatever they have given, all are macroeconomic policies. But they are saying which three of the following are the main macroeconomic policy objective? Low and stable inflation, that's a main macroeconomic policy. For example, if you are in the government, so obviously you will try your best that we should have a low and a stable inflation. If you are in the government and inflation is fluctuating, so what are you doing by sitting in the management? What are you doing? And then you are replying, I'm just sitting doing nothing. Please do something. So one of the main objective is low and stable inflation. High and sustainable economic growth. Yes, I believe every government wishes that. Either they achieve it or not, that's a separate question. But high and sustainable economic growth is another main macroeconomic policy. Full employment. Wow. Every government, every macro, the main objective of macroeconomic policy is full employment, that zero unemployment. But practically, this is not happening. Keeping the exchange rate fixed permanently, it is a part of a macroeconomic policy, but not the main part. A balanced government budget every year, again, okay. It's a part of macroeconomic policy, but that's not a main part. If you exceed that budget, if you have underutilized that budget, okay. But examiner has not asked us main macroeconomic policies. Examiner has specifically mentioned three of the following are the main. So which three? To us, it is first three. Now I want to say, add here one more thing. Some of the students, while sitting in exam and facing question like this, they actually become demotivated. Why they become demotivated? They try to recall and they could not find anything like this from the kit or maybe from the past paper. Then they just panic, become demotivated. Let me tell you, students, your paper is having 100 marks. You are attempting a 100 marks paper and passing marks are 50. If out of 100 marks, if I don't know a 2 marks question, that cannot make me fail. But by looking at this question, I become demotivated. I lose my, I would say, confidence. I become in a panic condition. Now that different, I would say, my mode, they will make me fail the paper. But only a 2 marks question alone cannot fail you. No, cannot make you fail. Impossible. It's just a 2 marks question. You just need 50 marks to pass the paper. It means you are allowed to do the 50% mistakes. So I'm just giving you one examination tip. While sitting in exam, if you look at any MCQs or any XYZ area which you have no idea at all, please don't become in a panic situation. That only a single question cannot make you fail. You are technically you are allowed to do 50% mistakes. Obviously, I'm not saying go there and make 50% mistakes, but I'm just telling you, be calm. If you don't know one or two things, it's okay. It's okay even to leave or just fluke. Even you out of 4 choices, you go for the fluke. Still, there are 25% chances you might be correct. So enough emphasis on unusual question. Let's see what they are saying. Which of the following statement are correct in relation to Islamic finance? Okay. Biha company, if I'm not wrong. Biha is a listed company seeking new sources of finance to fund a long-term investment project. The directors have been advised that Islamic finance is alternative source to conventional finance. Okay. Which of the following statements are correct in relation to Islamic finance? Which of the following statements are correct? Mudharaba is a form of equity finance. Yes. Where profits are shared according to the pre-agreed contract and losses are solely related to the provider of finance. Perfect. True. That is true. Musharga is a form of equity finance in which investment partners receive. We are having objection on this. Actually, investment partners, they don't receive dividend; they receive share of profit, and the losses are shared according to their capital contributions. So the second one is false because they don't receive dividend; they get share of profit. Okay. Sukuk cannot bear interest. Yes, Sukuk is the Islamic bond. The Sukuk holder return for providing finance is a share of the income generated by the bonds. Logical, true. For example, if my company raises the finance by issuing Sukuk and from that fund, let's say I'm going to buy a XYZ aeroplane. Now, how much return I will distribute to you as Sukuk holder, it depends on how much return I'll be getting from that aeroplane, what I'll be generating. So Sukuk cannot, I will not be paying the interest. Actually, I'll be distributing the return, but that return will depend how much return I'll be actually generating from that asset which I have bought, from that money which I have raised by issuing Sukuk. The Sukuk holder return for providing finance is the share of income generated by the bonds. Islamic instrument by their nature mean they are not traded through a secondary market. Secondary market is stocks in, that's incorrect. So from where I'll get the Sukuk? You will get the Sukuk from the stock exchange. So students, Islamic instruments, they are also traded on the secondary market. So which one is correct? We selected 1 and 3. Do we have any option? Yes, we do have 1 and 3. Which of the following action best reflects principle of value for money in an organization? How to save the money? Value for money. Let's see. Procuring goods and services at the most economical cost. True, that is value for money. Launching creative promotional activities to boost brand image. From where the value for money comes? Value for money is I'll be doing something economical, saving money. Value for money is I should be using the available resources in the best possible way so that I can get the desired results. Increasing profit distribution to share, that's not value for money. Optimizing the use of available resources to achieve the best output, this is value for money. 1 and 4. Okay. What is X dividend market price of the share? A company has just paid a dividend of 0.25 per share. It is expected to pay a dividend 0.265 in 1 year's time. Cost of equity is 15%. Student, dividend valuation model. We are required to calculate P naught. P naught is equal to D naught 1 plus G upon KE minus G. One more thing. D naught 1 plus G is actually is equal to D1. And D1 is next year expected dividend. So logically formula could be like this: D1 upon KE minus G. Growth rate very easily we can calculate. Examiner has given the dividend of current year and the next year. We can calculate the growth rate 0.265 minus 0.25. Let's see whatever comes into 100, a growth percentage. Annual dividend growth rate 0.265 minus. Student, annual dividend growth rate is 6%. This is actually D1 minus D0 divided by D0. So P naught is equal to, and let me tell you one more thing, KE minus G. Cost of equity they have given us 15%. G is 6, I'm getting 9%. 15 minus 6, I'm getting 9%. So very easily we can calculate now P naught. D naught we know that 0 point. Question, are we getting any question? Can we get the recording later? Yes, today's recording will be uploaded on the portal. So all the enrolled students, definitely they will get it. Plus, today's recording will also be uploaded on our YouTube channel as well. So you can see the recording over there also. But only today's recording will be available. After that, of course, we are not going to discuss the entire pre-scene mock today. We'll be discussing other parts as well. Other parts recording will not be available. That will be available to only the enrolled students. But today's recording definitely will be available on the portal as well as our YouTube channel. Okay. Yes, YouTube channel, everyone can subscribe. There's no harm at all. Just write Abil School and you will find our YouTube channel. P naught, P naught, P naught. Okay. D1 0.265 divided by 0.09. Let's see. 0.265 divided by 0.09. Sure, I'm getting 2.9444 and so on. Let's see. Beta is the option, students. Okay. Assuming 360 days in a year, what would be the yearly reduction in finance cost if management shortens the collection period by 30 days? Always remember, students, when the collection period reduces, your debtor will reduce. When your debtors, they will reduce due to reduction in collection days, means you will be getting earlier the amount. Then you will be actually saving the finance cost. So simply finance cost saving is equal to reduction in debtors multiply by interest rate percentage, which is normally an OD rate. Maple company has annual credit sale 12 million. With accounts receivable is 3 million. This is their existing receivable. Working capital is financed through a bank OD 10%. So I'll be using 10%. Company's cost of capital is 12. We have nothing to do with cost of capital is not relevant here. Here we need OD rate. Assuming 360 days in a year, what would be the yearly reduction in finance cost if management shortens the collection period by 30 days? Students, reduction in debtors. Credit sale is 12 million. it will be reduced, collection period will be reduced by 30 days. So credit sale multiplied by 30 upon 360 will give us reduction in debtors value. So let's see how much we are getting. Students, I am getting 1 million. Logically, your debtors will reduce by 1 million. Reduction in debtors into OD rate will give you the saving in finance cost, which is 1 lakh. Repeat, reduction in debtors into OD rate gives you the saving in finance cost. That gives you saving in finance cost, which is 100,000. Okay. Which of the following are features of an OTC, over the counter interest rate option? Students, first of all, you need to know one concept. Over the counter products, OTC products are available. OTC products are available only from the banks. OTC, over the counter products, are only available from banks. Number one. Number two, they are tailor made. They are tailor made for you. They are customized for you. Which of the following are features of an OTC interest rate option? Let's see. The terms of the contract can be customized to the needs of the buyer. Very much true. The contract is settled through a central exchange clearing house. False. The question is why false? Students, OTC is available from banks. It's a bilateral contract. I don't need any third party. You and the bank, that's it. I don't need any clearing house. The buyer pays an upfront premium to obtain the option. True, yes. Options, you have to pay the premium upfront immediately. Question. There's no question. Okay. The option provides protection against the adverse movement in the interest rate. Yes, it's an option. Option will save you from the adverse movement in the interest rate. Simply, when options, if you believe options are in your favor, in exercising the option, if exercising the option is beneficial for you, you will exercise it. Otherwise, you will lapse the option. So students, option, they actually protect us from the adverse movement in the interest rate. So we have got true, true, true. There are many true. 1, 3, and 4. So option, students, alpha. The right one is alpha. Okay. Which of the following best describes this policy? Which policy? Let's see. A company is reviewing its working capital financing strategy. Students, if you recall, we have three types of working capital financing policies. One is matching. In matching policies, we actually finance permanent nature of current assets. They are being financed by using long-term sources of finance, and fluctuating nature current asset, we use short-term source of finance like OD. Matching policy means we match the source of finance with the nature of assets. Matching. There's one more, which is aggressive. In aggressive, company will be using more short-term source of finance. So in aggressive financing policy, the company will have more focus on short-term source of finance. Conservative means company will have the more focus on long-term sources of finance. Let's see what they are saying. A company is reviewing its working capital financing strategy. It wants to minimize the finance cost. Stop. Students, minimizing the finance cost is only possible in case of aggressive financing policy. The question is how, sir? How? How by following aggressive financing policy for working capital we can reduce the finance cost? Very simple. Actually, whenever I'll be needing a finance, I'll be using OD, overdraft. Aggressive financing policy means whenever I'll be needing a finance for working capital, I'll be using OD. So the question is, sir, how it will reduce the finance cost? Very simple. When I'll be using OD, so obviously I will not use the overdraft throughout the year. I'll be using OD when it is required. If it is not required, I will not be using it. Obviously, when the company will pay the interest, when they have utilized the OD. If I have not utilized the OD, I will not be paying the interest. But obviously, there's a liquidity risk as well because you don't have the cash. You are just depending on OD. And OD is a banking facility which bank has given you. Whenever bank wants, they can withdraw that facility. It wants to minimize the finance cost even if it means taking higher liquidity risk. Obviously, you are not holding any cash. You're just depending on bank facility. Like just an example, you're that nowadays we are using credit cards. Technically, credit card money is not our money, it's a bank money. Whenever bank want, they can of course revoke that, I would say, a credit card facility. We cannot do anything. So bank OD facility is technically, when I'm using bank OD, it means my company is using the bank finance, that is not our finance. So it wants to minimize its an aggressive financing policy. Which of the following best describes? It uses short-term finance to fund both fluctuating and part of the permanent current asset as well. That is aggressive. Of course, for fluctuating, I'm using short-term source of finance, but I'm also using a portion of permanent current asset. They are also being financed by using short-term source of finance. It matches short-term finance to fluctuating and long-term. This is matching policies, not aggressive. It uses long-term finance to fund permanent and fluctuating. That is conservative. It holds high level of cash and inventory. This is again conservative. Last two are conservative. The second one is matching. But what they have written aggressive, and the only one matches with aggressive. Now, student, this is 110% logical question. You cannot answer this question if you don't have strong concepts. Some of the students, they try to memorize these things. That will not help you in FM. In FM, you like question like this, concepts should be extraordinarily clear. If with a normal understanding, I don't think so that a student can attempt this kind of a question. So question 14 then needs a very clear understanding of working capital. Very, very clear. So we should be giving at least credit to the examiner. He has asked a very good question. Thank you, examiner. Okay, what type of exchange rate risk would apparel company experience with $1 lakh loss in the consolidated financial statement? Students, very simple. An exchange loss of 1 lakh is expected to result in a consolidated parent and overseas subsidiary. What happens when there's a parent and overseas subsidiary? Parent will translate all the financial statement of overseas subsidiaries to parent's functional currency, and then parent is going to consolidate. Whenever you have got an overseas subsidiary, then you will be facing translation risk. And this is a normal example which I always give to my students whenever we start Forex. So students, we have discussed the entire, I would say, section A of pre-scene mock. Now, listen the announcement properly, especially I would say those they are enrolled. I want all of my students by tomorrow attempt the entire section B. Attempt the entire section B by tomorrow. In any question, if you have any query, you can always ask on WhatsApp. But let me tell you one thing. Just there should be one question on Forex. Let me tell you. Yes. Student, this question 21 till 20, that is a question on Forex. I would say I have mentioned there are two areas according to examiner's report. Students they are making many mistakes. One is working capital and then there is Forex risk management. First of all, you need to attempt all the section B questions. And just a little announcement. At least from section B, the question on Forex, I'm giving you the time to attempt this. Tomorrow, I'll be keeping one more class, and in that class, at least I'll be discussing this question on Forex. But I really want now every one of you, before that class, at least attempt this. But I would request try to attempt the entire section B by tomorrow. We'll be having a class as well. Then I'll give you one more day for the section C. So students, obviously those they are enrolled, they will be getting the support till the last day of exam. But I would say that today we have not only discussed the entire 15 question of the pre-scene mock. I think within each question, I have given you the proper explanation as well. With the explanation, I have discussed each and everything. What will be the time for the class tomorrow? But that will be actually, if I'm going to keep that class. That class will be only for the enrolled students. Apologies, those they are not enrolled. If they are interested to enroll, they can always contact admin. So students, please listen carefully. I really want everyone. So what I was saying, we did not just discuss first 15 question. We have actually discussed with the proper explanation. Now I'm giving you one day, attempt section B question, come up with the queries. I'll be more than happy to answer. And then you will be getting one more day for the section C. Again, you will be coming up with queries. Again, I'll be more than happy to answer all the queries of my enrolled students. Admin details. Let me just give you the admin details. Wait. Let me write admin number, admin number, admin number. Just a minute. We have got admin number. Just a minute. Those students they are outside Pakistan, so 0092 328 284 6117 328 284 6117. Students within Pakistan 0328 284 6117. So you can contact us. You can just contact the admin. And plus, there are many I would say practice videos are available on our portal. Plus, one more thing, all the enrolled students they know that our video lectures are not very long at all. One video lecture I would say is only ranging between 40 to 45 minutes. And within I would say 50 hours, you can just comprehensively cover the entire FM. So the support is available, short notes of FM are available, everything is available there. And plus, we are going to conduct FM mock as well, and I'm going to personally check that FM mock and I'll give you the feedback as well. So thank you very much for all the students. They came up for today's ACCA pre-scene mock. Thanks a lot that you people have taken out time for today's class, even though the timing of today's class was very odd, but still having these many number of students, that is something which is encouraging for the teacher as well. Thank you very much and wish you all the best. A very best of luck for your upcoming exam, March 2026. Thank you.